Hey everyone, this is Gregory Schulz from Shumway Van & Hansen here to talk to you again about a really important idea in real estate investment, something called a 1031 like-kind exchange. Now, investors bring this up to me pretty frequently because many people have heard about 1031 like-kind exchanges and have heard they might be a good vehicle to help them save on taxes. And so today, I'm going to explain a little bit about what a 1031 like-kind exchange is and what you need to be ready for in order to execute one effectively. So first, it's important to understand how a real estate transaction would work were it not for the existence of a 1031 like-kind exchange. By the way, 1031 refers to the section of the tax code that sets aside the laws for a 1031 like-kind exchange. So the way a real estate transaction would normally function is that someone who owns a piece of real estate investment property, they would sell that. The sale of the property would be a taxable event. And then once they would pay taxes on the investment proceeds, and then if they wanted to, they would use whatever money was left over to buy a new investment property. So the baseline is that whenever you sell a property, you have a gain or a loss, and you have to pay taxes on that gain if you have one. So the problem this creates is, let's suppose that I have a $200,000 investment property and I want to use the proceeds of that investment property to buy another investment property. It's sort of unfair to make me pay taxes on that property if all I'm going to do is just turn it into another investment property. So, provided you are going to turn your first property, your investment property, into another investment property, there is a way to defer your taxes. Now, it's important to note, it is not a way to avoid paying the tax. Ultimately, you will have to pay it. It just means that you don't have to pay it until you sell the second property. So the way a 1031 like-kind exchange works, in the basic case, is that you have an investment property that you were looking to sell, and then you find another one, the investment property you would like to buy, and then you simply exchange the two for each other. So whoever owns the second one signs over title to the first one in exchange for, whoever owns the second one signs over title to their property in exchange for your title to the first one, plus any other, perhaps some cash consideration that you two agreed upon. But the more common version of the 1031 like-kind exchange, or at least the one that I see people who are the most interested in executing, is a like-kind exchange where they sell the property, they get the cash, and then they use the cash to purchase another investment property. This is called the deferred 1031 like-kind exchange. And it's a little more complicated. Because if you want to do a deferred 1031 like-kind exchange, you have to involve an intermediary. You can't just hold on to the cash yourself. In fact, it's essential for the 1031 like-kind exchange that you do not receive the cash. Otherwise, it's a normal taxable transaction. So for doing a deferred 1031 like-kind exchange, you sell the property. The property proceeds go to some kind of third-party intermediary, and then you have a short period of time to identify a new target property, and then the intermediary sends the money to purchase the new target property. The money never goes through your hands. And the intermediary can't be someone with whom you have a pre-existing lawyer or accountant relationship. There are a number of title companies around the country who specialize in doing 1031 like-kind exchanges, and they know the procedure very, very well. So the advantage of doing a 1031 like-kind exchange is that the taxes don't start until you sell this property. So you can use the full amount of the money that you have in this one to invest in a new property without paying taxes until the ultimate sale. The important thing to know about a 1031 like-kind exchange is it only works for investment property. So you can't take your personal residence and then 1031 it into a new house. Can't do that. You can't take, in most cases, your vacation home and 1031 it into a new house. You can't do that. In order for you to do this, it has to be investment property. And what that means, the way the IRS evaluates whether or not it's investment property is if it has been put to an investment use for the majority of the last 2 years. That has been its predominant use for the majority of the last 2 years. So You can do this with your vacation home, provided that most of the time, over 50% of the time during the 2 preceding years, your vacation home is used primarily as a rental property that you perhaps stay in on occasion. So as long as its predominant use is as an investment property, it can then be subject to a 1031 like-kind exchange. You cannot do a 1031 like-kind exchange by yourself. You need that intermediary. And usually it's very helpful to have an attorney prepare the documents. So the 1031 like-kind exchange is a great way to reduce your tax liability, but it has to be with investment property, and it has to be with the use of a qualified intermediary. So if you're looking to do a 1031 like-kind exchange, I would be happy to help, and we can certainly point you toward all the people that can assist you in making this transaction work. Thanks very much.